Okay, happy Sunday, Checkmate crew. Today is Sunday, October 16th at 4:41 p.m. It is just about an hour, 20 minutes before the futures market opens. Today is a special session at the pit. I've been seeing a lot of noise on Twitter and social media about the 200-week simple moving average. That's the 200-week SMA on the S&P 500. We closed under it in the SPX, that's the S&P 500 cash index, and the S&P 500 futures contract on Friday the 14th, which is just 2 days ago. And now I see all this end of the world talk. So I just wanted to break it down for you guys with data and show you what has happened historically at these levels and what I'm seeing now from other data points. So let's dive right in. So first off, the 200-week SMA on the right here, you see the S&P 500 cash index, SPX ticker symbol. The white line is the 200-week SMA. And as I said earlier, we closed under it on Friday. On the left is a back test data. So Checkmate crew, you guys know me by now. If it's not backed up by data, it ain't right. So simple as that, really. So first off, we have the S&P 500, again, the ticker symbol SPX. We want to see what happens when the index price itself crosses below the 200 weekly SMA. This particular back test is what happens on the next day after the S&P 500 closes below the 200 weekly SMA. So as you can see from October 30th, 1953 until now, the S&P 500 has crossed below the 200 weekly SMA a total of 134 times. Okay. Now Friday's cross below it will be the 135th time. The reason why it is not included in this study is because we haven't had a daily close afterwards. We haven't seen a full occurrence yet, okay? But still, 134 occurrences, that's still a pretty good amount of data here. And as you can see, 52% of the time we end positive the next day. 48% of the time we end negative for the day, for an average final return of 0.11%. So, you know what? Let's just call it 50-50 for the sake of argument, okay? And as you can see, we had multiple crosses up and down the 200-week SMA in 1957, 1958 was a year where it just kept crossing up and down of those levels. 1969, another year where that happened. 78 and 82 are also years where we went up and down that 200 weekly SMA. We just kept crossing up and down below that. 82 also another year where that happens. 2001, obviously 2001 was where we had the dot-com crash, as well as that recession in early 2000s, and 2004 as well. Most recently we had that in 2020. Okay. But overwhelmingly, most of the multiple intra-year 200-week SMA crossings happened in the late 50s to the early 80s. Okay. Now, I can't stress this enough. The markets were very different back then. There wasn't the same amount of derivatives and options-based hedging that we see today. No machine-driven market makers, no dynamic delta gamma hedging on an intraday basis. And we have seen countless times where options activity can create these big V-shaped sudden recoveries. All right. We have gone over this many times in the Discord, as well as the market memo series. Okay. So the structure of the market was very different then, but still, let's include it in the study. All right. So that's 1 day returns. All right. Now, what happens in a week? In a week, most standard weeks, if it doesn't have a holiday, there are 5 sessions in a week. All right. So let's see what happens. Let's go ahead and back test this and see what happens. Now, in a 5-day period since 1953, we've had 55 non-overlapping observations of the S&P 500 crossing under the 200-week simple moving average. Positive returns in those 5 days versus negative returns for the same period is 51% to 49 right here. 51% positive, 49% negative, average final return of 0.49%, a slight nominal edge in positive returns. But again, for the sake of argument, let's call it 50-50, a coin toss still, all right? Now, if we look at it from an overlapping point of view, it's still very much the same statistic. It's still around 50%, so about 50-50, okay? Now, there's 132 occurrences if we count overlapping occurrences. Okay, now an example of an overlapping occurrence for a 5-day performance is when S&P 500 crosses, let's say, below the 200-week SMA on day one. Maybe it pops above it in a day or so, and then crosses back below it within that 5-day period. Now, when we look at non-overlapping observations, we only count the first cross beneath the 200-week SMA, and if it happens again within the next 5 days, we do not count that as a new occurrence when we observe non-overlapping occurrences. This is the overlapping occurrences. So whether it happens on day 1 or day 3, both of those are considered new occurrences. Okay, so that's why on an overlapping basis, you're going to see a lot more occurrences happening. All right. As you can see, still, a lot of those negative performances are centered around the 50s to the 80s, all right? Overwhelmingly so, 50s to 80s. This is where we had a lot of volatility. I always draw comparisons to high inflation right now to the late 60s and 70s markets. And so in those markets, we had basically from 69 to 80 or so, we had a lost decade, okay? So a lot of the negative performance comes from that, all right? And as we can see, as we get more and more modern history, we see these less of the big kind of stretches of time where we have this negative performance after crossing the S&P 500. After crossing the 200 weekly SMA. 1969 is just one of those years where we just crossed it so many times, okay? So that is the weekly return. Now, let's actually look for the monthly return. Now, in most months, we have about 21 trading days in a month, all right? So let's take a look on an overlapping basis. On an overlapping basis, there were 131 occurrences, okay? 131 occurrences. Now you can see the edge is now toward positive returns. Positive returns occurred 77% of the time after a month, after crossing the 200 weekly SMA. Negative returns 23% of the time with an average final return of about 3%. Okay, so no longer are we looking at 50-50 chances. Now it's about 3/4 of the time we see positive returns, and about 1/4 of the times we see negative returns. Okay, now what about on a non-overlapping basis? So again, non-overlapping basis would be it crosses below the 200-week SMA, and if it happens within the next 21 sessions, we do not count that as another new occurrence. All right, so in that study, 67% of the time there were positive returns after a month of after it crosses the 200 weekly SMA, and about 33% of the time we had negative returns. And again, the final average return was around 2%. Okay. As you can see here too, the September 30th, 2022 cross below the 200-week SMA is not counted in this study, as there has not been 21 sessions in the market since September 30th as of the filming date of this episode. All right. But we're starting to see a positive edge. Now, since 2007, 2008, the options and derivatives hedging market has exploded more than 10 times. And only in 2008, during the financial crisis, did we have a negative month after crossing below the 200-week SMA in more modern history, okay? If you go back, yes, again, the usual suspects here. We see 69, we see 71, the 70s, late 50s, these still had negative performances, or more so, after 21 sessions than in modern history in the last, let's say, 10, 15 years. Okay, so the structure of the market is a little bit different, but again, for the sake of argument, let's count as far back as we can go. All right. Now, what happens after a quarter? A quarter in 20. If there's 21 trading days in a month, for a quarter there is 63. All right, and let's look at this on a overlapping basis. So on an overlapping basis, again, it happens 131 times, and we had positive returns in 73% of the time versus 27% of the time when we have negative returns. But as you can see here, now the average final return is 4.75%. All right. So, and still the negative returns are still centered around that 1969, all right, and 1980 time frame. Actually, most of it is in 69, actually. All right. Again, that was the time when we had hyperinflation here in the United States from 1969 to 1980. Around 1980s, when Volcker became chairman of the Federal Reserve, and he raised rates 64 or something like that, 60 plus times, and caused 2 recessions back to back in order to calm inflation. All right. And so, a lot of that is centered around 69, 72, and 77. Now, in more modern history, we see most of the negative occurrences happening around 2001. All right. We see 2001, where you see those negative occurrences after a quarter. Okay. And because that was a more drawn out bear market. We could see that here too, right? We could see that right now too. But that is the case on a overlapping basis. If you look at it from a non-overlapping basis, and again, which would be the first time it crosses below that 200-week SMA, if it crosses below again within 63 trading sessions, it does not count as a new occurrence. And if we do it on a non-overlapping basis, there were 26 occurrences, and again, around 3/4 of the time were positive, a quarter of the time were negative. Average final return was 4%. And again, same usual suspects, 69, 70, and we can see in more modern history, it only happened very few times, okay? Let's look a little bit long term. What happens in a year? 252 trading days in a year. This year was the first year where we had 251 days. We added an extra holiday, but just for the sake of being consistent, I'll use 252 days. All right, and on a overlapping basis, we had 131 occurrences. All right, 131 occurrences. 70% of the time, all right, we were positive. 30% of the time we were negative, for an average final return of 12.93% for the within a year. Okay, and so again, most of that is centered around 69 and 70s, and in more modern history, we see that in around 2001. Okay, but after that, after the options market really started taking off, we saw less and less of that happening. All right. If we look at it on a non-overlapping basis, obviously we're going to have less occurrences. All right. We have only 17 occurrences. So again, if it crosses below the 200-week SMA and within a year it goes up and crosses below again, that is not a new occurrence. So if you just consider it the first time that it crosses, it happens 17 times on a rolling 1-year basis, and positive returns are 76% of the time, negative returns are 24% of the time. So now we're back to that 3/4 edge, and the final average return is about 10.57%. Okay. Let's look at, so first of all, if we go back to the non-overlapping, okay, let's go back to the non-overlapping 252-day study. Let's look at the years where we have losses, okay? Some of these losses, especially in the more modern era, that's 2001, as you can see, you know, a lot of these losses, you know, we could have mitigated, right? In Theta Thunder episode 1, I show you guys how to make at least 10% covered call writing rate of return. Okay, so 10% from writing covered calls on a yearly basis, selling low delta calls. Okay, low delta calls, very low risk, very, you know, manageable to sell to make about 10% yield. So as you can see, those 1 year returns really aren't that bad. I mean, in 69 there are, but if you go, you know, to 2001, you know, these returns not so bad. I mean, 10%, you would have been able to mitigate some of these losses. Also, if you use that covered calls to buy protective puts, your losses would have been even more mitigated, and you would have been able to cash out of those hedges and buy more shares cheaper, really exponentially growing your share count in something like SPY. Okay, but that's a 1 year study. Let's look at 2 years. Okay, 2 years would be 504 trading days. All right, let's look at it on an overlapping basis. On an overlapping basis for 504 trading days, that would be about 2 years. We had 131 occurrences. 84% of the time we had positive returns. 16% of the time we had negative returns. We had a final average return during those 2 years of 21.45%. Okay, 21.45%. All right. Now, most of these losses, you know, as you can see here, 68, 69, we don't have losses. All right. We do right here at 68, but for the most part, it's sometimes flat or a little bit higher return. But if we go, 69, we do have some right here. We do have some losses. But again, 2 year losses of 1%, 2%, 3%. Again, Theta Thunder selling those low delta, delta 10 to 15 covered calls, you would have been able to mitigate this loss. All right. Now, if we go to 2001, that's where we start seeing some of the bigger losses. Like, you know, we had 26, 25, 20% losses in 2 years. And again, if you can sell those covered calls and make 10%, and then you use that premium to hedge, you would have been able to cash out those hedges and buy the SPY S&P 500 Index ETF and cash those out and buy more shares at cheaper prices. And I know these numbers look very disheartening, but again, this could all have been mitigated with some of the strategies that we have in Theta Thunder. Again, selling premium around a quality asset and continuously hedging. All right. This way you can compound your share count. So in the end, you would have generated a lot of wealth during this time. This was a great opportunity to buy and generate that wealth. All right. Now let's think a little bit more long term. Let's think about 10 years. Okay. Most people are, most investors are savers. They're long-term investors. Most people just stash away money in a 401k and continuously buy. So let's look at 10 years. 10 years will be 2,520 days. Okay. 2,520 days. What is our performance in 10 years? Well, I'll tell you. Boom. How many times has it happened? 125 overlapping observations. The positive returns happened 100% of the time in any 10-year rolling period. From 1953 to now, we have not had a losing 10-year rolling period. The average final return is 124%. All right? So now I just want you guys to keep this in mind here. None of these returns that I just mentioned in this video, from the beginning of the video till now, none of that includes dividends or dividend reinvestment, which is arguably one of the largest sources of wealth generation in this country over the last 100 years. And it does not include any of our premium selling covered call strategies, yields from selling cash secured puts for assignment, and hedging using that premium from selling options, again, which we cover in Theta Thunder. So in 2011, that was the last 10-year rolling period that we can observe, because anything that happens after that, we haven't had 10 years to observe the study. But out of those 125 overlapping occurrences, all have been profitable. Okay? So, moral of the story. What does this all mean? It is possible that we could see some negative returns in our short-term, in the short term. We could see definitely negative returns in the next day or so, or a week or so. So as stated earlier, within a day or a week, it's anyone's guess which way it will go. It really is a coin toss. But in today's market, I use a lot of our liquidity indicators. You guys know about these liquidity indicators. For those of you who follow along on the market memo, our junk bonds advanced decline line and the New York Stock Exchange high-low line, both right now currently on as of the close on October 14th, both are pointed down and are still going down. Let me actually pull up a picture of our junk bonds ADL. Right now, this is our junk bonds ADL line. Okay, as you can see, it's still pointing down. Our New York high-low line is still pointed down. Generally, we want to see this curve up. We also want to see our junk bonds ADL make a higher high and a higher low to see a trend reversal. All right. Now, just because these indicators are pointed down doesn't mean we can't have a rally. Okay, but if those conditions, if these weaker liquidity conditions stay, we are more likely to see that rally get faded sooner than later. It's very difficult for the markets to endure multi-week or multi-month rallies if these liquidity conditions are not stronger. All right. Now, as I mentioned before on this video, the options market is very different now than what it has been in the past. And I'm limited in how far I can go back in options data. I only have access to October, November of 2009 and forward. But in current markets, we are right there where we have a large pocket of negative gamma options positioning around that 3575 to 3600 zone. And we're approaching a monster October options expirations, or OPEX. All right, now this is a zone where we could see dealers have to run to cover their short puts, and if they do, we could see a weakness begets weakness situation where we undercut these levels and shoot back down to 3500 zone like we saw on Wednesday, Thursday. Remember, on Wednesday, Thursday, we saw that shoot down. We saw basically we saw a little bit of a panic with dealers that were short puts. Initially, they brought this down to 3,500. There was a pivot there. There were starting to be some positive gamma and long puts that were cashed, and then we saw the VIX really take a tumble, and we saw the markets rally from there. Okay, could we see that again? Yes, we can. All right, and we've actually anticipated this. Back in mid-September, when we noticed all this negative gamma positioning after the September OPEX, and the links to that video where we anticipated this is in the description below, so you guys can review that. And really, we've been talking about this possibility since July and August as well, based on options positioning. So yes, it could happen. Now, this is especially true if IV, implied volatility, and the VIX keep rising in the next couple of sessions. All right, if it does, we could see that weakness begets weakness. We could see an undercut of this 3575, 3600 zone and get to that 3500 zone in the S&P 500. However, if we see the VIX drop, okay, if we see the VIX drop, we could see an October OPEX squeeze higher, as we are nearing options expiration. We only have 4 or 5 days now. So we have heavy in the money put positions on the S&P 500. Look at this. Look at where we are now, 23,000, 32,000. So if you look at this on a nominal basis, the S&P 500 cash index options is nominally about 10 times more expensive than a SPY share. So it's almost like looking at a SPY open interest of 230,000, let's say, for the 3600 strike. All right, that's the same nominal value as 230,000 options on SPY, but it's 23,000, 42,000, and 3,700, all the way to 4,000 with 57,000 in the money puts, open interest for the October OPEX. And delta neutral is around this zone. The delta neutral in S&P 500 right now is around 3,900 to 4,000 zone. Okay. Again, this is why from the market memo, my hedge zone is around 4075 to 4125 zone. This is where we have seen a large amount of derivative hedging this whole year, and I plan on buying put spreads to hedge my long-term SPY shares at that level. Okay, so that is all short term. Okay, the long-term takeaway of this study is that for those that are looking to build long-term wealth, this is not a bad place to start legging into quality shares like SPY. This is not financial advice, however, so if you want to know whether this is right for you or not, you should consult a financial advisor, but the data is overwhelming. I'm just showing you the data and you can do with it what you wish, but I have already started implementing my plan at longer-term share accumulation. As you guys know from the market memo, I've sold some puts for assignment at that 366 zone on SPY, and I'm ready to buy additional shares outright if SPY gets to that 340, 345 zone. I myself will never sell my SPY shares ever in my life and will hold it forever because I know the minimum income I can generate from SPY shares from selling low delta short-term covered calls and dividends. So price per share is really meaningless in the long term with this strategy. As I accumulate shares, I know my income and cash flow generated from my holdings will only increase with time. That is putting time on my side and setting myself up for the data to be in my favor in a long-term wealth generating strategy. So I really hope this video adds some light to what's going on in the markets today. There are links to our Discord in the description below. Come join our Discord. Be a part of a growing community. No sub fees, no paywalls. It's of the people, by the people, for the people. And if you enjoyed our video, hit like, follow, and subscribe. Comment. Show us some love, baby. I'll see you in the coming weeks for the next market memo. Tuesday, Wednesday, Thursday, 9:30 a.m. Eastern Time at the New York Stock Exchange opening bell. Have a wonderful rest of the weekend, and I'll see you guys in the coming week.